We're going to get started here in a minute. I see a lot of people filtering in. Really excited to launch this new educational series. 3 questions, 20 minutes, 1 guest. It's an idea that we came up with to bring on different folks from out the industry with different experienced experts that we've worked with through our career, to help shed light on issues that are affecting real estate investors, be it passive or active. For those of you who don't know me, my name is David Hansel, and I'm one of the founding partners and managing members of Lucern Capital Partners. We're a real estate private equity firm based out of Red Bank, New Jersey, and we primarily focus our investments into multifamily, value-add multifamily, and industrial, specifically flex warehouse space. And a lot of our concentration is throughout the Carolinas, and we have holdings up in the Northeast. So we're going to get started here in just a second. Again, really happy to be able to bring this forward. 33 questions, 20 minutes, and 1 guest. And our first guest for our first series is a friend of mine, someone that we've worked with at Lucern for quite some time, John Darrow, who's got a very interesting background throughout the capital market space. I'm going to give him the floor and let him share a bit, and then we'll go into the questions.
Thanks, David, and thanks for having me on this. I'm excited. Yeah, so my background started in the great financial crisis 13 years ago or 14 years ago, I guess now. And at the time I was working in New York City, and I was buying distressed loans from banks for a private credit fund, hedge fund, whatever you want to call it. And I did that for roughly about 5 years until about 2015, at which point the cycle had materially changed. So there wasn't as much distress at that point in time, but spent the better part of 5 years sourcing those loans, buying them from banks and insurance companies and various different sellers of distressed debt here, largely anyone that was getting taken over by the FDIC. 2015 pivoted to doing agency originations, so Fannie Freddie loans. It was shortly thereafter that I actually met you and Frank and Mark and your team here, but started.
I think it was a steak dinner in New York after a closing, right? It was
I think
in
it was
an old
like
subway
that.
station, right?
Yeah, no, that was Wolfgang's on 31st and Park. It's very near and dear to me, but
yeah.
But so I was doing small balance loans, and as actually, even though I was living in New York City, I was doing a lot of business throughout the country, primarily in Texas. So I was traveling to Texas a ton, and that's actually in 2017 I met my wife here. So that was the reason that I ended up leaving New York City at the time, was to move south and get married, and have since. I'm still on the banking side here. I just do more generalized mortgage banking here. So have diversified away from just doing lending for agencies. I still do a lot of multifamily business, but in the last 3 years or so, I have started doing a lot of self-storage and industrial retail. I did a lot of land loans over the course of the last 24 months.
Yeah.
I've also been working with developers on ground up construction. We actually did a construction loan together, and hopeful here, fingers crossed, about to sign up a hotel deal here in the next few days. So
It's great. I mean, John's very humble, and his experience and his ability to structure debt is really incredible. Like, you know, there's an art to it as much as there is having the connections and being able, understanding where to take risk and where not to. He's been a huge part of our success. And, you know, I'm happy to have him on. So without further ado, we'll get to some meat and potatoes here and try to dig into the market from someone that sits on the side of arranging debt. So as a high level question, Can you talk to me what the commercial real estate debt market looks like today? You know, challenges or opportunities and where we stand.
Sure, absolutely. I appreciate the kind words, David. But yeah, in terms of the debt markets today, I was joking with a colleague a few weeks ago, and the best way we came up with to describe the debt markets is functionally dislocated, which is definitely an oxymoron, but it's probably the most accurate way of describing it. So starting with the functional aspect, the markets, there's still a lot of lenders out there in the market. Obviously, you have the agencies, Fannie, Freddie, that are lending to multifamily operators here. You have the CMBS market, which is still going strong here, and they are still providing liquidity. I tend to do a lot of life insurance lending here for clients. You and Frank and your team here, we've done a number of life insurance loans this year. And you know, in terms of pricing here, the life insurance, I'd say, is still the best. The best that I've seen here recently is 140, 150 over for really good quality product, good sponsors, good historical financials. And then that ranges all the way up there through, you know, I'd say CMBS is for performing loans. CMBS is, you know, if you have something really good, you're in the 200s, but if you don't have a lot of historicals and you just need to get the loan refinanced, CMBS is roughly in the 300s is where spreads are pricing. The other thing that is functional about the market right now is that perm debt is actually priced better than bridge debt. And I'll get into that later here, but for a while there, 2 or 3 years ago, that was the opposite. It was cheaper to get bridge debt on everything than it was perm debt. So that's why every deal was marketed as value add, so that lenders would buy it and they would do a bridge on it. But we have flip-flopped. So we are now back at a point where perm debt makes more sense than bridge debt. Now on the flip side, when I say dislocated, there's a few things that are going on right now, which is making the market a little dislocated. Obviously, the yield curve is one of them. So it is more expensive to borrow short as opposed to long here. So if you want a 3 or 5 year piece of paper, which most people do right now, what we end up seeing here is the pricing on that is a lot higher than if you were to go out to the market and say borrow on a 7 or 10 or 15 or 20 year piece of paper. So that is one of the biggest dislocations. Is most guys don't want that. They are under the expectation that rates are going down, so they want 5 year paper or 3 year paper with the lowest prepay. The other thing that is dislocated about the market is construction financing. So I would say, you know, more or less since Labor Day of 2022, so a little bit over a year ago, is when capital markets really started to pull back and absorb the Fed rate increases, and construction financing really started to get prohibitively more expensive. And what we've seen now, and I'm sure you can relate to this, David, is a lot of construction has either you were going vertical and you're going to finish out the project, or you have halted your project here now.
Yeah.
So what we're going to witness here is once all of those properties that are in the process of getting built are done, there's going to be a gap here for what I would venture to say 24 to 36 months, where there's not much supply of anything coming out of the ground. So there will be, you know, which will be nice for the supply and demand here. Obviously, there won't be as much supply, so there will be greater demand on what is actually built in the newer construction that's getting built. Yeah, construction debt right now is very expensive, and you're not getting high loan to cost here, so it doesn't make a ton of sense.
That leads well into the next question that we had. And I can attest to those issues as far as going ground up at this point in time, and there just being a void of a lot of capital for that. But what lenders are active in the market? What's really challenged to finance, you know, and what is actually out there, who's lending, and where are the opportunities, because you can find a good deal, but if you can't get good financing for it, it may not be a good deal. Conversely, if you get really good financing, it's a mediocre deal, it could become attractive. So back to the question, just the current market, who's lending, who's not, what issues are there with that?
Yeah, so we roughly touched on that in the first question, but obviously the agencies are still providing liquidity to multifamily. So you have Fannie and Freddie there. Their terms are roughly in line, for something that's more mission driven, you're 170, 180 spreads, and then you kind of range up from there. CMBS, we spoke about their spreads, but they're still active in the market. One of the spaces that's seen the biggest, let's call it reshuffling of the table, is the bridge space. So, and I'll speak specifically to the multifamily bridge space. MF1 is still, they were the largest CLO lender, and they're still very active in the market, and they're doing business. After MF1, though, what we did see was a lot of the bridge space getting gobbled up by the likes of the agency lenders, whether that was Arbor or Lument or some of those agency that was doing a bridge to agency is what they call them. What we've seen though is Arbor and Lument specifically, and then a few others, but they've pulled back dramatically from the market here. So they are not your go-to bridge lender for multifamily here. But with that, I would say that other groups have stepped in. I know Greystone has a group of separately managed accounts, so they've started doing some lending. I know a few other groups are stepping up and they're doing some of the bridge work. So it's not that there's a lack of capital in the bridge space. It's just best way to call it is a reshuffling of the table here. But I think the largest, and then one step further, the life insurance lenders are still very active right now. Something to keep in mind when you're dealing with life insurance lenders, historically, they are best as first and second quarter lenders. And by that, they get an allocation every year. The quicker they fill up that bucket, the quicker they can, sit back and see how things develop. So I would tell most people, if you're looking to do a life insurance loan, first and second quarters when you get the best pricing, best terms out of them. But they're still active here, and they still are gobbling up deals. I do a lot of business. That actually a deal I did with you, David, was with Standard, and Standard I think will do almost 70-80% more volume this year than they did even last year. So they're going to have a banner.
That's a great statistic, especially when you're hearing about a lot of some of the lenders that have pulled back, and it's good to hear about other ones stepping up.
Yep. No, they definitely stepped in here, and Standard's a great lender. I love doing business with them here. So, but I guess the biggest change here in terms of who's out of the market or who's having a hard time, I'll call some indigestion, is the banks. And that largely, you started to see some issues in January, February this year, but Silicon Valley Bank, SVB as we refer to it, was, I like to call it that was the Cat 5, the Category 5 hurricane that made landfall. That was just that sent a lot of shockwaves through the system. And then suddenly you had lending officers and credit people in every single bank going through and analyzing where their depositor base was, how many people were over $250,000, who can move their money quickly. And then it just, that was literally what sent shockwaves through the banking system. And I was reading something in the journal a few months back, but the credit unions and the banks are responsible for something like 60 to 65% of all CRE lending. Now, that excludes multifamily because you obviously have Fannie and Freddie in there, but think about, strip retail, flex industrial. So that space is very dislocated right now. And one thing that we have seen come out of that is banks will say, all right, cool, I'll extend you this loan, but I want, 10% of the loan amount on deposit at the bank. So suddenly you're sitting there borrowing $1 million, but you have to move $100,000 of deposits over to the bank. And it's just very, it's hit or miss based on which bank you talk to on any given week, because it'll they may have 10 million to put out this week
Right.
because they had 10 million to pay off last week, but yeah.
Well, that's so rolling into our last and third question, kind of tease that up as well. I mean, what's the next year look like in terms of deals and rates, and can you touch on the banks, because they're a big part of the market that have kind of pulled back?
Yep. So where I sit here, I can speak objectively to, I've seen deal flow pick up in the last 60 to 90 days. And I think that is a result of us getting to the end of the tightening cycle with the Fed. So there's more visibility from investors, buyers, sellers, banks, everyone here, to where things are likely largely going to be settling out. So the good news is I am bullish here in terms of activity going forward, because I get the feeling that now we just have, we can see the light at the end of the tunnel. We may not love what it looks like here. Cap rates will definitely be higher and valuations have adjusted, but life goes on here, and we can start picking up and getting deals done. So that is the good news. Office is definitely still dislocated here. I am personally of the opinion, if you have the right capital, that you will get generational buys in office here. Maybe not yet. It may take 6 to 12 months. We may have to wait and start seeing banks actually foreclosing and then selling the office REO. That's probably when we're getting close to the bottom. But I do believe that office will be that generational buy that you'll look back 10 years from now and be like, man, can you believe that I bought that at $10 a foot or $20 a foot, and now the thing's worth 200. The flip side is multifamily. I like to say that some of the investors and owners on multifamily are still wearing blinders here for two reasons. One, the valuations on multifamily, whether or not people want to admit to this, they've moved. So the reason that there's not a lot of transactions in multifamily right now is because the market clearing cap rate is probably 100 basis points higher than what the brokers are whispering to people. So we would see a lot more transactions if, what people were thinking were 5 caps were priced at 6 caps, or the 6 caps were priced at 7. But until we get to that point, I'd say the transaction volume in multifamily is going to be either down or challenged or whatnot here. And that's really just a product of, there's a lot of debt on these multifamily buildings that is higher than where you could go right now and get refinanced out at. So what people are sitting here trying to understand is, all right, what do? I am unfortunately over levered on this property. Do I have to go and do a capital call, pay down the debt, and refinance into a perm deal, or do I take it to market right now, hoping that there's someone that will pay me yesterday's value when the rest of the market has realized that yesterday's value is no longer there? I mean, perfect example. If you bought a deal last year that had $1 million NOI, and it, unfortunately, you may have paid a 4 cap for it, that's a $25 million valuation. Now, fast forward to this year, you raised your NOI 10%, so you're at 1.1, but I'm going to argue market clearing cap is probably a 6 today, given that interest rates are close to a 7 or 6.5 for perm debt. So on a 6 cap valuation on a 1.1 NOI, you're at 18.3 million. So think about it. Last year, if you did an LTV of 73 on 73% or higher on that, your equity is pretty much wiped out. There is no equity left in that deal here. So what do? Do you capital call and have to double your equity basis in the deal to put on a perm loan? Or do you take it to market, try and sell the property and deliver zeros to your investors? So it's one of those where there's some digestion going on right now with multifamily investors, and it's not all of them, but there was a large portion of the market that was getting financed with bridge debt because it was cheap there for a while. So, but then, to come full circle here, David, where do I think rates are going? I'm kind of the mindset, if I look at my computer right now, what are they, 465 on the 10-year? Maybe we get down to 4%. if we get down to 3% or the low threes, I'm going to ask, like, what broke? And do you really want to be buying when something has broken in the economy here? Did we lose another bank? What happened? So my mindset is I'm hoping that rates stay right around here. I am cognizant of the fact that I think it could go up, but I think it's going to be choppy. So that's why I tell clients all the time, listen, if you see something you like, don't try and game the market, because 10, 12, 15 basis point moves are average on a day right now. And especially with the banks or the insurance companies, they'll lock the rate day one. So just lock that thing and just know that you have locked in your rate and you don't have to think about it again. But yeah, I would not try and get cute in this market here, trying to play Jay Powell or Alan Greenspan and guess when, oh, hey,
it's the first offer, best offer mentality that you should be.
Absolutely. So yeah, that's my advice to clients that I work with. You see something you like, or it's, hey, that works for your numbers, just take it.
Right.
Don't think twice about it.
Right. Yeah, we're in an interesting inflection point in the market. And I think the way you're thinking about debt and exits and acquisitions has to change a bit. We're doing that internally at Lucern. And it's really, really helpful to have people in our network and team like yourself. I want to thank you, John, for joining us. You could find John Darrow on LinkedIn. He's been an incredible resource to us for the capital markets. So if you're needing someone to look at that, he didn't know I was going to give him a little promote there, but really, really thoughtful about what he does. I want to thank everyone that's joined us today, and hopefully will follow up with us in the coming months as we bring on some other guests. We'll be sending out some info about the next date and the next guest shortly. We're going to be bringing on one of the brokers from Capstone, who runs the group down there and is someone that we've worked closely with side by side. So keep an eye open for that. Again, thank you. Hopefully these 20-25 minutes were useful, and enjoy the rest of your day.
Thanks, David. Thanks everyone.
All right. Bye.